This is Debt Free in 30, where every week we take 30 minutes and talk to industry experts about debt, money, and personal finance. Here's your host, Doug Hoyes.
Today we're going to talk about a topic we've discussed before here on Debt Free in 30, payday loans. You've heard me give my thoughts on payday loans, and I've had other licensed insolvency trustees and credit counselors on the show to discuss the evils of payday loans. We all know the problem. They charge very high interest rates. In Ontario, they can charge $21 on a $100 loan. So if you get a new $100 loan every 2 weeks, you end up paying $546 a year, which on a $100 loan is a 546% interest rate on an annual basis. That's the problem with payday loans. But what's the solution? Should the government have a greater role in regulating payday loans and short-term loans? Is that the solution? Would it work? If so, what should the government actually do? We already have laws regulating payday loans here in Ontario and in most other provinces, and that hasn't solved the problem. So is the government the answer? That's the question I want to ask my guest, who isn't a licensed insolvency trustee or credit counselor, and he doesn't work for a bank or payday lender. So let's get started. Who are you? Where do you work? And what do you do?
Good morning, Doug. Thank you for having me. My name is Jonathan Bishop. I'm a Research and Parliamentary Analyst at the Public Interest Advocacy Centre here in Ottawa. I do policy research on a variety of subjects, including payday loans and financial services issues.
Can you tell me what the Public Interest Advocacy Centre is? So do you go by the initials? How do you refer to it?
Around the office, we go by PIAC. Anybody that deals with us on a regular basis, that's kind of what we're known by. But the Public Interest Advocacy Centre is a nonprofit organization and a charity that provides legal and research services on behalf of consumer interests, and in particular vulnerable consumer interests concerning the provision of public services.
So you're looking at people who you're doing research into issues that help real people. You're not trying to figure out a way to make banks more profitable. You're dealing with the actual real person is what you're doing.
Yes.
So what kind of projects have you worked on in the past?
In the past 2 or 3 years, myself, I've worked on issues related to wireless data roaming, the Commissioner for Complaints for Telecommunications Services, payday loans, obviously, loyalty programs, online group buying, the amount of money you pay to receive a paper bill for a communications or a financial institution bill on a monthly basis, things of that nature.
So a wide variety of things. So let's talk then about payday loans. So you've done some research into this area. Why don't you start me off with a short history lesson then? So what is the state of payday loan legislation, in Canada, in Ontario, wherever you want to start?
Sure. The Public Interest Advocacy Centre has been investigating payday loans for well over a decade. Prior to 2007, the maximum rate for all loans in Canada, according to the Criminal Code, was 60%. However, at that time, an exemption to the criminal interest rate was passed to allow payday loans, which were operating in Ontario at that time, in provinces that have opted to permit it. So Ontario had them, but they didn't have any regulations really around it. So the amendment to the Criminal Code in 2007 kind of permitted what was already there. To my knowledge, only Newfoundland and New Brunswick are the provinces remaining that don't have active payday loan legislation. Quebec, for example, has gone a different route than many of the provinces by limiting the criminal rate of interest to 35%. This has in effect curtailed the operation of payday lenders there.
Just a question on that then. So in Quebec, the maximum interest rate that can be charged, I guess, by any lender is 35%. Is that correct?
That's my understanding, yes.
And that's curtailed payday lending just because it's not profitable to do it.
That's my understanding. I know there are still storefronts there, but they're not offering products on a similar basis as they do in other provinces.
Gotcha. Whereas, as I said in the introduction, in a place like Ontario here, the maximum interest rate, which is governed by federal law, as you said, what we call the usury laws, I guess, is 60%. But the payday loans get around that. Is it because of this specific provision that you talked about going back to 2007?
That's right.
That's what it is. Okay.
Yeah.
So they're charging on an annual basis a higher rate of interest, but there's a special rule that allows them to do it, is essentially what happened. Okay.
When the amendment was introduced in 2007, the provinces were told that you could regulate the interest, the maximum rate of borrowing on a payday loan if legislative measures that protect recipients of payday loans and that provide for limits on the total cost of borrowing under the agreements were put in place. So what's happened is that's occurred in many of the provinces. New Brunswick's established payday loan regulation, but they haven't put it in place yet. They haven't finalized it.
Gotcha. So these laws have been in place in Ontario for a number of years, and yet I understand that, and I think you were probably the one who made me aware of this, that Ontario is now considering revisions to the existing rules. So this is Bill 156, am I correct?
Yes, you are correct.
So tell me about Bill 156. What's the point of Bill 156?
Sure. Bill 156 was introduced at Queen's Park in December. It began its political life as basically a sentence in the mandate letter in 2014 from the Premier to the Ministry of Government Consumer Services, committing the ministry to, quote, exploring opportunities to increase protection for vulnerable indebted consumers, such as modernizing payday loan legislation, end quote. So in order to effectively check that box, the ministry began a consultation process last summer asking for comments. They issued a paper that had about 22 questions in it. The Public Interest Advocacy Centre answered that call with a 50-page document of policy analysis, and we also attached a recent research report on debt collection practices because that was part of the questions that were asked by the ministry. And so Bill 156 is the end result of that consultation process.
We're now in the spring. It's April of 2016. The bill has, I believe, gone through first reading. Presumably there'll be lots of committee work and so on and so forth. So would you agree with me that it's unlikely we're going to see any new legislation in 2016? Is this more likely that it's 2017 if anything happens, or could it happen quicker than that?
It could happen quicker than that if there's the political will to make it happen. However, with Bill 156, a lot of where the rubber's going to hit the road, so to speak, will be when regulations are established. And that won't be until 2017, even if the political will is there to pass this bill by the end of 2016.
Gotcha. And obviously they have the votes because it's a majority government in Ontario right now, but it's whether they want to do it. And you're right, the devil is in the details. The legislation itself will contain a few lines, but then there are regulations which actually spell out how it works. And I think this is exactly what we saw with the legislation that I believe came into being in 2015 in Ontario with respect to debt settlement agencies, for example. The legislation itself was reasonably short, but then there are regulations that actually spell out how it works. So it's the same concept, I guess, that we're going to have to wait to see the regulations. But what is specifically included in Bill 156 now that would impact on payday lenders?
Well, specifically, there are rules in here in 156 to change restrictions applicable to replacement payday loans. So, for instance, in the bill, there's rules saying if you get to a third payday loan in a period of time, then that payday loan becomes essentially, they won't say so, but essentially an installment loan that has to be paid over 62 days rather than a 2-week period or that kind of thing. They're going to attempt to lengthen out the repayment time. Specifically, there's a couple of other nuances in here as well.
But is that the big change then?
That is one of the big changes, yes.
So right now, I go get a payday loan. It's due on payday, which is 2 weeks from now. So 2 weeks from now, I've got to come up with the money to pay it. Plus, I've got to pay the charge that was added on top of it. So my $100 loan, I got to pay back $121. But I don't have the money, so I can't go to the same payday loan place and borrow again. I can't get a loan from Company A to pay off the loan from Company A under the existing rules. But I can go to Company B, borrow from Company B, come back to Company A and pay it off. Under the new regulations, if I get a certain number of loans from the same company in a predefined period, the third loan can't be just another 2-week loan. It's got to have a longer time period. Am I understanding the gist of it correctly?
That's right. If you get into a third payday loan agreement within 62 days, then that third agreement has to be repaid in 62 days.
Gotcha. Okay. So what they are trying to do is break this cycle. So let's get into some solutions here then. So we understand now conceptually what the rules are today in Ontario, and in many provinces there is a cap on how much a payday lender can charge, and under the new rules there will be perhaps the requirement to extend the payment terms to give someone a little bit of extra time to pay them off. I want to hear your thoughts on what possible solutions there are then. So should the government just adopt Bill C-156, and does that correct all our problems? Well, I'm sure the answer to that question is no. So why don't you walk me through some specific solutions that I don't want to say that you are advocating them, but things that you think are at least worthy of consideration. Where would you start?
Well, there are a number of potential solutions to investigate. From the mundane. So when, say, part of this problem with payday loans, or the challenge, is access. Consumers have lost access in many instances to traditional financial institutions just because they moved out of their neighborhoods. So in an instance such as that, it may be beneficial to consumers if the Ministry of Consumer Services, say, a trusted voice, were to able to provide them with locations and business hours of alternatives that are within walking distance or within the neighborhood, rather than waiting, than having a payday loan institution come into their neighborhood that replaces the bank, so to speak, in terms geographically, and then then operate.
So what you're saying is that banks now, there are fewer branches than there used to be. If we looked at the number of branches 20 years ago and the number of branches today, it's a lower number. And a lot of that's because we now do online banking and things like that. And what you're saying is a lot of the branches that have closed in perhaps less affluent neighborhoods. And so those people perhaps don't have access to cars to go into the next neighborhood to use a bank, and as a result, they perhaps are being more drawn to payday lenders who are on every corner, sort of like a coffee shop. So you're saying one possible solution then would be to provide different physical location access then?
Yes, that's correct. I mean, there's a little more to it than that, but yes. The researchers in this field call this whole process redlining, where banks essentially redline a neighborhood and move out because they want to focus on products that provide more return on investment. So rather than, say, being in one central area of Toronto, they'll move out to a place like Whitby where they can concentrate on financial products that will give them a better return, leaving that inner city neighborhood without that financial institution. Another part of this that we found is the evolution of big box stores kind of crowding out local retailers, where those local retailers used to do things like, say, cash your paycheck for a fee. Now with the removal of that local retailer, some citizens are left with having to go to another organization that might charge them an exorbitant fee in order to do something simple like cash a check.
So the local grocery store, hardware store used to fulfill some of the functions of a bank, like check cashing, for example. Just I want to make sure I understood then on the first point about the redlining and the banks moving out. So you are suggesting what is the alternative? That different organizations then come in to pick up the slack, so to speak?
Well, there are a couple of that's happened in other jurisdictions. Say, for instance, credit unions have come into the fray with products and offerings that are somewhat similar to a payday lending product. I can think of the good folks at Van City have offered a kind of fast and free loan or something. It's fast and friendly loan or something of that nature. In Montreal, going back to the Quebec example alluded to earlier, there a advocacy group that works in conjunction with financial institutions to offer a longer-term loan product at a very low interest rate. I believe in Thunder Bay there's also a movement to offer a product that's in competition with a payday lending product. There are examples, but they're kind of few and far between, sprinkled throughout the country in terms of products that could be comparable to a payday lending product.
Gotcha. So it may be credit unions. It may be other types of organizations that pick up the slack. Okay. So back to the solutions then. So I'll let you continue. We talked about access. We've talked about how big box stores have crowded out some of the smaller retailers that were providing some of the functions of banks. What are some of the other things on your list of possible solutions?
And then there's a little bit more of the creative solutions, one of which PIAC had put in its submission to the Ontario government, it's that the government consider supporting legitimate microcredit initiatives to replace the high cost of these alternative financial service loans with microcredit options. So you'd have to. We suggest the government partner up with, say, local financial institutions in order to make these offerings. So it's not just relying on those folks, like say at a credit union, to kind of enter into this field, but provide some incentive to enter into this field in order to help consumers. So that's one of those more original options.
So when you say microcredit, what do you mean by that? You're talking about loans that are under a certain amount. Is that really what microcredit would be defined as? So kind of a loan of under $1,000 or $2,000 or whatever.
Right. I mean, we've heard from industry spokespeople in the past that say, look, the payday loan product is used to say it's cheaper than, say, having my electricity disconnected and then reconnected, or going without groceries, or going without something for a short period of time and paying a fee. So for like I say, a disconnection. So holding these industry folks to their word, put out a competitive product that addresses that need for that immediate cash fix, but doesn't necessarily mean you have to get stuck on a debt treadmill.
So let me play devil's advocate here. We've got the payday loan companies and these other short-term lenders. A lot of them are now internet-based, but they're all out there. Presumably, they're making a profit. So I just want to play devil's advocate on this here. So we've got these payday loan companies, short-term loan companies that are obviously, I guess, making money, or else they wouldn't be there. The banks don't want to go into that market because presumably they don't think they can make money. And so what you're saying is, well, maybe we need to give a little bit of help to either the traditional financial institutions who already make $1 billion every 3 months, each one of them, or we need to help perhaps credit unions or small local initiatives to do this. Well, if the payday loan companies can make money at this, why would there be any need to support other people to also do this?
Well, I would counter that by saying if the payday loan industry was a purely competitive industry that wasn't just a creation of a regulation or regulator, then these payday loan providers would compete on the basis of price, and they don't compete on the basis of price. They all hover around the maximum rate of borrowing allowed by regulation. They don't seem to offer that kind of, in other markets where they don't lower the price in order to entice competition, they all just seem to hover above the top. So if it's a structural issue, maybe there needs to be some injection of competition through something of a nature like helping out another institution to provide a competitive product, not out of the need to subsidize a large corporation like a bank or a credit union, but for the benefit of fairness to the consumer.
So if I was to say to you, okay, Jonathan, I have $100 million in my pocket, and you and I are going to start a financial institution, and we are going to focus on microcredit. We're only going to give loans of $1,000 or less, and we are only going to charge a maximum of 10% interest. So we are going to put the payday loan guys out of business by offering the exact same product at a much lower cost. Would that work, or would you and I lose money because we weren't charging enough?
I'm not sure if we'd make any money, Doug. However, I know that particular model does exist, and it is operating in Montreal. The good folks at Option Consumer Tour offer a product in conjunction with a financial institution that charges an interest rate somewhere in the neighborhood of 5% for a loan that is somewhere in the realm of, I think the limit is $1,000 or $1,500. and it's repayable over a couple of years. It's not in an effort to make Option Consumer or the group that's doing this rich or anything of that nature. It's just a matter of offering the service to assist consumers. That's my understanding.
Gotcha. So it may require then an organization that is doing it not for profit, maybe on a break-even basis, to be able to shoulder the costs of making these types of loans without needing to make a huge amount of profit on. So, okay, well, I'd like to hear some more potential solutions. We're going to take a quick break, though, and then come back and talk more, and maybe you can give me some of your more far out ideas on how we can address the payday loan situation. So we will take a quick break, and I'll be right back with Jonathan Bishop. You're listening to Debt Free in 30.
You're listening to Debt Free in 30. Here's your host, Doug Hoyes.
Welcome back. It's time for the 30-second recap of what we discussed today. My guest today was Jonathan Bishop, the Research and Parliamentary Affairs Analyst for the Public Interest Advocacy Centre, and he discussed with us the results of their research into the payday loan problem in Canada, and he shared with us many possible solutions to help consumers get out of the cycle of payday loan debt. That's the 30-second recap of what we discussed today. As frequent listeners to this show know, payday loans are a problem because they charge very high interest rates and they require the borrower to pay the loan in full on their next payday. That's often not possible, so a second payday loan is taken out to pay off the first one and the cycle continues. Jonathan made some good suggestions to help alleviate this problem. He suggests that if a payday loan lender allowed a borrower to pay off the loan over a few pay periods, that may alleviate some of the problem. The math makes sense. Paying $800 on my next payday may leave me with no cash for rent or other living expenses. If I could pay $200 on each of my next 4 paydays, that may leave me with enough cash to cover my other debts and therefore not make it necessary for me to keep borrowing to stay afloat. The proposed Bill 156 in Ontario does include a provision for longer repayment terms, so that may help. My worry with all of these tweaks is that they may help a little bit, but they aren't addressing the underlying problem. A lot of payday loan borrowers have a lot of other debt. They're maxed out on their credit cards and they can't borrow from a bank, so they turn to payday loans. If we could address the underlying problems, one of which is excessive debt, perhaps the need for payday loans would be greatly diminished. I've got a lot more to say on this topic, but we're out of time on today's show, so stay tuned for future episodes where we'll discuss payday loan solutions in more detail. Until then, please visit hoyes.com, that's HOYES.com, for full show notes and links to the PIAC website. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.
Thanks for listening. That was Debt Free in 30.